Hi guys, welcome to my YouTube channel. Here I am back with another informative video. The topic of our video is to discuss how to set up a holding company to reduce taxes in 2025. Guide for business owners and investors. As a tax strategist, I often work with entrepreneurs and the investors looking for ways to optimize their tax liabilities while protecting their own assets. One of the most effective yet often or misunderstood structures for achieving this is the holding company. Holding company, when used correctly, a holding company can provide a substantial tax saving, liability protection, and the financial flexibility. If we talk about that, what is the holding company? A holding company is a business entity that owns and controls all the other companies or the assets, but does not actively engage in the operation itself. That it does not works itself, but it owns and controls other companies or their assets. And If we talk that instead of selling products or the services, it primarily holds shares, real estate, intellectual property, and other investments. so from a tax perspective, a holding company can serve as a strategic tool for the reducing taxable income, deferring tax, and the optimizing profits across the multiple businesses. For example, instead of owning multiple businesses in your personal name, you could create a holding company to own them, which would hold all your multiple businesses, helping you centralize management, reduce liability, and gain the tax advantages. It has many historical uses of holding companies, and historical use of the holding companies for the tax strategies are the holding companies have long been used as strategic tax planning tools. Some key historic example include, the first example is the Standard Oil. In late 80s and the late 90s, um, John D. Rockefeller used a holding company to consolidate ownership of multiple oil companies, effectively reducing competition and controlling pricing. However, due to antitrust concerns, Standard Oil was broken up in the 1911. The second historical example of the holding companies for tax strategies is the modern corporate conglomerates, uh, which range between 1950s to present. Companies like Berkshire Hathaway, Warren Buffett, and the Alphabet, Google's parent company, use holding structures to manage taxation efficiently while controlling multiple businesses. The third historical example use of the holding company for the tax strategy is the offshore holding companies, which is also available from 1990s to till present. Tech giants like Apple, Google, and Amazon have used offshore holding companies in Ireland, the Netherlands, and the Cayman Islands to reduce global tax burdens. However, the international tax laws have tightened in the recent years with initiatives like OECD's global minimum tax, aiming to prevent corporate tax avoidances. Here we will discuss that types of holding companies and their tax implications. The first type is pure holding company. If we go into the details, we will discuss that a pure holding company exists solely to own shares in other companies and does not participate in the business operations. It has many tax benefits like income received from Subsidiaries like dividends may be taxed at the low corporate rate and compared to individual income tax rates if structured properly. In the intercompany dividend may be tax free and avoiding double taxations. The second type of holding companies and their tax implications is the mixed holding company. A mixed holding company both owns other businesses and participates in their preparations, tax benefits, business expenses, management fees, salaries, and administrative costs can be deducted. Losses in one subsidiary may be used to offset profit in another, reducing taxable income. The third type of the holding companies and their tax implications is the financial holding company. A financial holding company owns its financial institutions such as banks or the insurance firms and is subject to strict regulations. It has many tax benefits, which include the first one is that special tax treatments may apply depending on the jurisdiction, such as preferential rates for the financial income. The second one is the income from the interest, dividend, and the investment may be tax deferred in the certain cases. The fourth type of the holding companies and their tax implications is the personal holding company PHC. Personal holding company, which also known as the PHC, is a corporate controlled by a small number of the individuals, typically earning passive income from their investments. So it has many tax risk as compared to the other types. The first one is the IRS imposes a personal holding company tax of the 20% on undistributed passive income if the company does not meet the active business requirements. So, and the second tax risk is to avoid this, PHCs, the personal holding companies, actively distribute earning and the reinvest distribute earnings or reinvest profits to into the active business operations. So tax benefits of the holding company are the first benefit is the tax efficient profit distribution. And so, as we talk, that many countries, including US, allows the tax-free intercompany dividends between a holding company and its subsidiaries, meaning that profit from an operating company can be moved to the holding company without immediate tax consequences. The holding company can retain earnings or reinvest funds in other businesses or delaying taxation. And the second benefit is to reduce corporate tax rates by structuring subsidiaries in low tax jurisdiction. A holding company can minimize overall corporate tax liability. For example, a US business might set up a holding company in Delaware, Nevada, or Wyoming, which have no state corporate income tax on the holding companies. International companies may establish holding companies in tax friendly locations like Ireland, Singapore, or Switzerland. The third benefit is asset protection and the tax shielding. A holding company can help protect assets from lawsuits and creditors, also while also optimize tax efficiency. Real estate investors often use holding companies to separate the liabilities from their personal assets while deducting property related expenses. Business owners can use a holding company to hold valuable intellectual property and license it to their subsidiaries, creating tax deductible expenses. The fourth benefit is capital gains tax reduction. When a subsidiary sells an asset or a business unit, the capital gain tax can often be reduced or deferred if the sale is structured through the holding company. The fifth benefit is to business expense deduction. Holding companies often serve management entities, allowing for the deductible expenses such as salaries and bonuses for their own owners and the executive. That was all about holding company. Hope this will be very helpful for you. So do follow and subscribe my channel for more helpful stuff.